Okay, let's unpack this. We have a fascinating deep dive today, focusing on two colossal yet really opposing strategic visions playing out in the European financial services sector.
It's a great one. We're looking at Utmost Group selling off its specialized insurance division, Utmost Life and Pensions, or ULP to JB Holding Company.
And this really is a tale of two strategies. On one hand, you have Utmost laser focusing, specializing entirely on wealth solutions for the super rich.
Then on the other, you have JB making this aggressive, capital-driven splash into the hyper-competitive UK pension market.
So our mission today is pretty simple. We're going to analyze the mechanics of the deal, trace the strategy behind Utmost's big move, and then try to figure out what JB's ambition really means for the old guard, the players who've dominated UK pensions for years.
It's a clean break for Utmost and a definitive entry for JB. So let's start with just the core facts of the deal. They really tell the story.
Okay, so the seller is Utmost Group, and the buyer is JB Insurance.
Right, which is basically the global insurance arm of the much bigger JB Holding Company.
And what they're buying is the entire ULP division. So that includes the bulk purchase annuity business, the BPA franchise, and also a closed UK life and pensions backbook.
And this is not a small platform JB is picking up. I mean, you're talking over £5 billion in assets under management.
Wow.
Yeah, and it serves around 290,000 policyholders. To keep it all running, about 175 employees are expected to transfer over with the sale.
Okay, and what about timing? This isn't happening tomorrow, right?
No, it's still subject to regulatory approval, so we probably won't see it close until, say, mid-2026. And it's important to note, no price has actually been announced yet.
But we do know what Utmost is doing with the cash. It's all about financial hygiene.
Absolutely. The number one goal for Utmost here is deleveraging. The proceeds are basically earmarked to pay off the bank debt they took on when they bought Lombard International back in 2024.
So it's not a distress sale, it's a strategic cleanup.
Exactly. It's about cleaning the balance sheet to focus on growth, which means Utmost now becomes this pure play on its Utmost Wealth Solutions business, or UWS.
And that remaining business is huge. It already administers over £107 billion in assets under administration. So this sale just strips out the other stuff, leaving a massive wealth platform.
If you look at it from Utmost's perspective, it's a masterclass in strategic focus. They're doubling down on what they do best.
Let's get into that history a bit. Utmost's core business, even before this, was always these life assurance-based wealth solutions.
Right, mostly unit-linked policies designed to preserve wealth for high net worth and even ultra-high net worth families across the globe.
And that Lombard International acquisition at the end of 2024 was really the key moment.
It was the pivot point. That deal massively sharpened their ability to handle the really complex planning needs of these global clients. They cemented their spot as a market leader, and now they're just optimizing the corporate structure to match.
The numbers seem to back that up. H1 2025, they had gross inflows of £5.3 billion, mostly from the UK and Europe.
And they have a group solvency coverage ratio of 171%.
Okay, so for listeners who aren't deep in insurance finance, what does that 171% number actually tell us?
It's a huge flag of financial stability. It means they hold 71% more capital than the regulator says they absolutely have to. For their clients who are all about capital preservation, that kind of stability is everything. It's the bedrock of trust.
So Utmost is cleaning house, but the buyer, JB Holding Company, they're making a mess, a very strategic mess in the UK market.
It's a fascinating shift.
I mean, this is the company famous for Keurig Dr. Pepper, Pret a Manger, coffee and sandwiches. Why are they suddenly buying 290,000 UK pension contracts?
It's a complete identity transition. They're pivoting away from the volatility of consumer goods towards a model that is all about acquiring cheap, stable capital.
And we're talking about the float, aren't we? The policyholder premiums.
Exactly. They see those premiums as a source of permanent capital. Think about it. Policy liabilities are very long-term, they're predictable, and you can't just redeem them on demand like a bank loan.
So the capital is cheaper and way more stable than other types of funding.
Precisely. And that cheap, stable capital, that float, becomes the fuel for their much bigger engine. They can take that premium income and go generate superior returns by investing it in illiquid private assets.
Things like private equity, real estate.
Right. They're playing the arbitrage between the low, predictable return they owe the policyholders and the much higher returns they can get in private markets.
So this ULP acquisition, then, is less about managing pensions and more about just securing a giant stream of capital for their investment platform.
It's a massive blueprint.
Right.
Once this and a few other deals close, JLB will be managing something like $35 billion in policyholder liabilities across the US and the UK. They're building a global insurance footprint at lightning speed.
Okay, but let's look at the asset they bought. For utmost, ULP might have been non-core, but it wasn't a weak business.
Not at all. The quality of the platform is high. ULP actually built a really competitive BPA franchise very quickly after entering the market in late 2024.
Right, I remember they did that Stonegate Pub Company deal.
That's the one. They focused on a critical niche, the smaller and mid-sized pension schemes that the big guys often ignore. This gives JB a ready-made, functional, regulated platform to hit the ground running.
So an ambitious buyer takes over a well-oiled machine. What does that do to the rest of the UK BPA market? The number of competitors stays the same, at most out, JB in? But the dynamics have to change.
Oh, the dynamics are shifting dramatically. JB is not going to sit still. They're going to be an extremely ambitious growth player, and that means you should expect a net increase in market capacity and a sharp increase in competition.
So how does a new player like JB, with this float-first mindset, actually threaten the big established UK players, the Legal & Generals, the Avivas, the Phoenixes of the world?
This is where the cost of capital arbitrage really bites. The publicly listed UK players, they have to deliver consistent margins every quarter to keep shareholders happy.
So they have to price deals at a certain level.
Right. JB, on the other hand, is backed by private capital with a super long time horizon. They can afford to be more aggressive on pricing. They can take a slightly lower margin on the pension deal itself.
Because the real prize for them is investing that float for the next 20 or 30 years.
That's the core of it. They're willing to make less money now to lock in that cheap long-term capital, which makes it incredibly hard for the incumbents to compete on price.
And this isn't a one-off event.
No, this is the third international acquisition of a UK bulk annuity business announced this year. It just confirms how attractive this sector is to foreign private capital that's hunting for stable liabilities.
So the outlook is pretty clear. ULP, under JB's model, is set to accelerate. And Utmost, now Pure Play Wealth, is perfectly positioned to grow in its own niche. Two focused growth stories from one deal. All right, that brings us to our high-risk, high-reward segment. And a reminder, this is just market analysis for experienced investors, not financial advice. We're just applying what we've discussed to what could happen in the market.
So my wild yet plausible trade idea today is a pairs trade. It's based entirely on this cost of capital arbitrage we've been talking about.
Okay, lay it out for us. Who wins and who loses here?
Well, the bet is on the continued convergence of these big private asset managers into the insurance space. So the idea is to go long one of the architects of this model.
The private asset managers themselves.
Exactly. Since Oaktree's funds own a majority of Utmost and Brookfield Asset Management owns a majority of Oaktree, Brookfield becomes a really good proxy. So you'd go long Brookfield, betting on the success of this whole capital aggregation strategy.
Along the architects of the float arbitrage, I get it. And the short side is betting against who?
The short side is betting on that margin squeeze. So simultaneously, you'd short one of the smaller, publicly listed UK BPA incumbents, maybe a Just Group or an M&G.
Why them specifically?
Because they are directly in the line of fire. Jay-Z's entry, with its cheap, permanent capital, is almost certain to drive down pricing and margins on new deals. That makes their near-term earnings targets a lot harder to hit. It's a bet on private equity's long-term advantage over the public market's quarterly demands.
A fascinating test case for capital structure theory playing out in real time. Okay, so to wrap up our deep dive, this transaction really crystallizes two very distinct paths.
It really does. Utmost gets a clean, debt-reduced balance sheet to go all in on its high-growth, high-margin wealth platform. And JB gets a strong foothold in the UK to hoover up stable premiums to fund their private asset investments.
So here's the final provocative thought we want to leave you with. When a giant like JB decides that the most valuable thing it can buy isn't another coffee brand, but a stream of stable, long-duration liabilities, it asks a really big question. Is the financial value of the float, those predictable premiums, now a greater driver of success in the life assurance sector than traditional things like organic sales growth or capital adequacy? Is this operating model, pioneered by private capital, the undisputed future of insurance?
Something to keep in mind as you watch this sector going forward.
That's all the time we have for this deep dive into Utmost and JAB. Thank you for joining us to analyze the strategies behind the numbers.